Comprehensive Guide to Risk Management, How to Never Lose. Partial Profits. Closed half here, moving my stop at break-even and letting rest run risk-free. I am very sure you have read this somewhere before. People love to take partial profits as they feel like they took something from the market, and now they are not exposed to any risk. Using the same trade as in the previous example, you can see profit-taking is split into two parts. The first part would be close at 1.5R and the second at 3R. Let's break this down a little bit. First of all, let's consider that you would not use partial take profits and closed trade full at 3R. If you risked $300 on this trade, you would make a profit of $900. But if you split your take profit like this into two parts, you would only end up with $675. You can view this as taking two separate positions of $150 risk. The first one is closed for $225 profit 1.5R and the second one for $450 profit 3R. Compared to the all-out, all-in approach, this would cost you approximately 0.7R on this trade. Of course, contrary to that, if you would close only half of the position and then the market would turn on you, it would result in a smaller loss, but more often than not, taking partial profits only offers us comfort and is not beneficial in the long run. Adjusting risk parameters. Another thing that traders often do is reducing size during losing streaks and increasing size during winning streaks. If you remember looking at different equity curves, you might have realized that markets give you a random distribution of winners and losers. This is why sticking to your strategy is the most important thing, as you might get poor results in 10 trades but excellent results in 500 trades. Anyway, let's say this is your random distribution of 10 trades. You are risking a fixed $100 per trade with 2:1 RRR. The distribution of profits and losses would be following, ending in a total profit of $800. As you probably noticed, you had a string of 4 losses in a row during this period. Many traders would feel insecure about this and decrease their size to half until they get at least 2 winners, for example. The profit and loss distribution would be following, ending in a total profit of $600. Similar to partial profits, this is not a favorable approach to your trading. Instead, I recommend categorizing strategy to different setups and tracking the performance of each setup individually while setting a stop trading trigger on every single setup you trade. For example, you can say that if your moving average crossover setup would experience 10 losses in a row, you will stop trading it and review past performance and try to either improve it or get rid of it completely. This is much smarter than constantly adjusting position size because you have hit a bumpy road. Although increasing your size during winning streaks also doesn't make much sense, you might get yourself into the situation when you trade 2 setups somewhat systematically as they always look the same, follow the same rules, and so on. Setup A might have a win rate of 40% with 2.5R and occurs 5 times a week on average. Setup B has a win rate of 80% with 3R and occurs 2 times a month on average. Should your risk be the same percent or dollar amount on these setups? Not really. Of course, don't go all in on Setup B, but if you find out that Setup B occurs during very favorable market conditions where you can step in with confidence, you should put more risk behind it. Just don't go too crazy. Break-evens. Most of us are technical traders. We use price action, order flow, indicators, and so on to determine our entries, invalidations, and take profits. All this technical knowledge is then thrown away once we move our stop loss to the least technical level in the trade, which is just a random price point of entry and has nothing to do with the invalidation of our trade. Break-even is the same thing as partial profit. It's a psychological comfort blanket that reassures us that we beat the market today and we won't leave our desks mad after losing money. This is one of the most common examples of ruined trade which I'm 100% happened to you in the past. You are getting on a level of support targeting the next level of resistance, nothing complicated. After getting into the trade, the market instantly squeezes you. After some time sitting at drawdown and being nervous of possible loss, we finally push higher. This is the point where you move your stop loss to break even as you don't want to experience this discomfort of losing money again. The market immediately returns to your entry, taking you out for break even and rushing to the target. Was your trade invalidated because you got out for break even? No, you were just scared of losing money. What you should do instead is moving your stop loss based on your strategy and invalidation. On this chart, we can also see one great concept called evolving R. Evolving R. Looking at the arrow on the chart, you can see you are approximately 80% to your take profit, but the market is starting to struggle. Since we moved higher, your invalidation on trade also moved higher, but it's still just below your entry. It means that if the market would turn just a few dollars before your take profit and take you out, you would not only lose a small amount of money on the stop loss but also give back all the unrealized profit. This is why it can be very beneficial to close the trade and miss that last small amount of gains instead of risking giving it all back. I look at the order flow, which can give signals of tables turning. Leverage. In the trading industry, when things go wrong, leverage always takes the blame. Retail traders blowing accounts left and right is always because of leverage instead of poor risk management and greed. So what is leverage? Leverage is tied with margin. Margin is the money you get borrowed from a broker to open bigger position sizes. You will often see 110, 130, 1:100 leverage. If you use 1:100 leverage, you will only need $1,000 to open a $100,000 position size in Bitcoin. The problem with this comes when the price of Bitcoin starts going against you. Let's say Bitcoin is $50,000 and you long 2 BTC using $1,000 margin. If Bitcoin drops 1% to $49,500, your position gets liquidated and you will lose $1,000. Of course, a 1% move in Bitcoin is nothing unusual. These mass liquidations of retail trades were objects of many regulations and discussions in recent years, not only in crypto but also in legacy markets where all products are highly leveraged. On the other hand, if you have working brain cells, know how to manage your risk and position your trades properly without being greedy, you will never have these problems, and you can start using leverage for your benefit. Exchanges are doing their best to be your best friend, especially in crypto, where you have CEOs interacting with the common folk, influencers promoting collaborations and overall doing their best for you to trade there. Also, why wouldn't they when over 80% of retail traders lose their money and exchange makes money on them? This is where you can use leverage to your benefit. You should never forget that exchanges can go down instantly, especially those with fewer regulations offering questionable instruments to trade. Not only that, you can, of course, get hacked, get funds stolen and so on. But if you can use 130 leverage, you don't need to have that much money on the exchange. For example, let's say you are trading with a $100,000 account. If you are trading Forex, where one standard lot equals $100,000 with 130 leverage, you only need $3,333 in the margin to open one lot. Thanks to this, you can keep a relatively low amount of money on the exchange. I usually have around 20% of my account balance on the exchange. This is more than enough to cover the margin requirements, and although in the eyes of the exchange you risk 10 to 20% per trade, it doesn't matter. If the exchange goes down, it will, of course, sting to lose $20,000, but it's much better than losing $100K. Journaling. Throughout this whole video, you might have noticed how important it is to rely on stats as they are your guide to proper risk allocation. Important metrics for journal are as follows. Journaling is not fun, especially on losing days. The last thing you want to do is to sit down and relive the moments when you screwed up, but it's worth it. One of my favorite things to do during times of bad period is to go through my journal and look at my profitable trades to compare them with current losing trades to find out if I make any mistakes or I'm just in unfavorable market conditions. Also, journaling won't be the same for everyone. If you are a scalper and take more than 10 trades in a single session, you would lose your mind journaling all of them. One of the huge advantages of some journals that I mentioned in the article is they have automatic trade imports via API or broker statements. This way, you will gather data without manually putting the trades in. If you are scalping, I would recommend you record your screen while trading and journaling days as a whole, how you performed, how you felt and so on, as intraday scalping tends to be more of a discretionary approach. Make routine with journaling, screenshot every trade once it's done with annotations and journal it. I journal my trades on Wednesday and Saturday but find whatever works for you. Building a small account. So now you know most things about risk management and you are ready to trade, but you don't have much money. When people ask me, I usually say that trading with proper risk management is not worth with less than a $10,000 account or at least $100 risk per trade. It can be a harsh truth because most people can only afford to start with $2,000 or $5,000 account swing trading while having regular jobs. Risking 3% on $2,000 equals $60 risk per trade. This will result in a tendency of over-risking, as you will see some results, but they will simply not be enough. Although you often find crazy stories online, building an account with fixed and conservative percentage risk per trade takes time. Instead, you should risk a fixed amount of dollar or contract size per trade, which is slightly higher. Once again, all of this has to be backed with some experience. If you are new, you can trade demo or just put a really small amount of money and risk 1 to 2% per trade for a couple of months to gather the data. Gather the data part is extremely important here because you will know your stats, how many consecutive losses you can experience, and your risk of ruining the account. If you have this data, anything between 3 to 6 months of profitability is optimal. You can apply this fixed ratio risk management. To make a long story short, you set a fixed dollar or contract amount as a risk for each trade and increase it once you increase your account by a certain size. Putting this to practice, let's say you start day trading S&P 500 futures with a $5,000 account, and you are trading one contract. Your average stop size is 3 points, which equal $150 or 3%. Of course, this is a little bit high for day trading, but since you are backed with data and journaling your trades, you know that the risk for running this account to zero is very small. If you manage to make this work, you will only need 3-4 to make 10% in account gain. This way, you can double your account rather quickly. Once you double the account, you will also double your trade size to 2 contracts. So now you risk $300 per trade on a $10,000 account. Still a little bit too much for day trading, but it's nothing crazy, and it is built upon what you gained, which will boost your psychology as you make that money. You can keep doing this until you feel like you have sufficient capital to risk only that desired 1 to 2% per trade. I can't stress enough how important it is to know what you are doing and being 100% confident in your trades. You can achieve this with backtesting, but usually, backtests give over-promising results compared to real trading. Trading psychology. I feel like this video wouldn't be complete without few words about trading psychology, as this is something so many people rely on and usually blame when they lose money. We as human beings can be quite complex, and I can't speak for everyone only from personal experience. Since I have been doing this for a while, I had a period when I used to read some books about trading psychology, listen to podcasts, meditate, etc. Without a doubt, all of these things can be beneficial, but I never found any real help with trading. If you wake up and meditate for 20 minutes every day, you might become less of a pain in the butt for your closed one, but trading is about clicking buttons, not sitting quite in the corner. Everything you think is fault on your bad psychology is usually caused, but not enough screen time and experience. We live in crazy times where everyone is an internet millionaire, but trading is all about hard work, screen time, and sticking to your rules no matter what people online tell you. As I don't want to get too opinionated against trading psychology, I know most new traders tend to lean to it instead of watching charts and trading. This, in my opinion, is a huge mistake, as the most experience you can ever get is gained from participating in markets, not courses, books, or podcasts. Preparing to trade. One of the best things I ever read about trading is, every day you start at zero. It doesn't matter if you lost or made money yesterday, it's a new day, and you need to focus on that instead of your prior wins or losses. What is extremely helpful for me is prepare in the morning or the prior day. It doesn't take much time, and there are templates online to make it easier for you. At the end of the day, it doesn't matter how you will do it, but what you will find out after you make it a habit is that you start to remember what markets are doing and come well prepared for every trading session. Once again, this might be more suited for day trading. If you are a swing trader and only take a couple of trades a week or month, your preparation might be more focused on setting alerts or placing limit orders and so on. Conclusion. Risk management is simple yet can be very discretionary and complex. I hope I covered the core concepts and things that you won't find in conventional wisdom. We are all different with our lifestyles, account balances, and approach to trading. Therefore, there is no right or wrong answer to how to manage risk properly. You very often hear that trading is not a sprint but a marathon. This is true, but I would prefer to say that trading is all about gathering data and build confidence in what you are doing through screen time. Your job as a trader is to show up tomorrow. There might be no tomorrow if you bet the house.